Alright, so what you should do first is, so we're going to give you some kind of structure for doing the project. So we'll take the example of oil, okay, which is one of your commodities. So you have to just repeat. Obviously I can't cover all the commodities, so you have to repeat this for most of the other commodities, okay, other assets. Okay, so what we have to do is, we can start first of all. So the fundamental part I'll come to later. I'll show you where to get fundamental information. The theory of fundamentals is a little bit more complex, okay, and a little bit more, it does not have that much structure actually. And whereas in the case of TA, especially the style of TA that we have covered so far, okay, just looking at simple trend analysis, that is a much simpler set of ideas, okay, and actually that is quite powerful. Okay, so you should not be fooled by the simplicity. This itself, what you have learned so far, is actually, if you just apply what you've learned so far in a systematic manner, it can actually, you can use this for the rest of your life, and actually you can find it can be quite successful if you're disciplined about it. Okay, you have to be very disciplined. Okay, here we have this. Alright, so how do you set up this? So the first thing so we are going from a TA perspective now. Initially we are just covering it from a TA perspective, then I'll come to the fundamentals. How would you do it from a TA perspective? Obviously you have to look at the price action. Okay, so these charts normally we refer to in TA as price action. Okay, so what you have to do is, as I've told you, one good practice is make sure you have as much data as possible. Your data range should be as sort of wide as the circumstances allow. Okay, so here you can see this data range starts on Oanda. The data starts from which period? 2004 something. Yes. We had something in 2004. I can't see the dates fully, okay, on this display, but it's around 2004. But we have a better chart, and I will try to put all the links into your into that standard file where we are putting all the links. Okay, so here I found one chart. Okay, this is the Index Mundi chart. This may, I can try to make this a little bit bigger. Actually, there's a better view of this chart somewhere. So this is actually oil prices from, I want to just blow up this image, but anyway, that's not happening. So if you see this chart now, so one of the things you should do is long-term, as much long-term data as possible. This is from 1988 onwards. Okay, you can see from 88 to 98, you can see where oil prices used to be. This is very useful because oil is such an important commodity globally. Just studying the history of the oil price will teach you a lot about what happened historically, what happened in terms of the oil price shock and all that. You don't see the oil price shock here. Actually, I might have a better chart, but let me just stop here for the moment and I'll show you the chart later. But so point is to get as much data as possible, okay, and then you have to form a view, okay, because you're doing TA. So which means when you're doing TA, your view has to be based completely on past price action, and then you might look at volume and open interest and all that. We don't need to get into all that at this stage. Just price action, and since we have not studied any technical indicators, you don't have time to. You can read up on them on your own. You can read up using that. I've given you that chart school link. Okay, so you can. That's a good link. That's a good source of information. So you can read up on technical indicators if you want to, and if you want, you can practice. On Oanda also you have many technical indicators available. Okay, so you can use all that. But for the moment, I'm just going to show you simple, very simple pattern-based analysis. Okay, so you look at all this. You can see this is where the price is now. Okay, so this is, you can see the long-term history of the oil price. And so what you have to do is you look at this, and then we will come to you. Ideally you should set up this kind of a palette view. You need not have 8 windows. If you want to have only 4 windows, that's up to you. I've given you 8 here because it's a maximum. I like to look at all the different time frames, but there's not much value addition in some of the additional time frames. So you can easily cut this down to 4 if you want. Now how will you get this? What you have to do is, I'll just show you the way to get this. Let's say we have, I need to open another browser because here I've got this login. Let this remain. So I'm going to open another browser. On this, what we are just going to open web charts on Oanda. Okay, we're going to open web charts. So obviously in one browser, Oanda will accept only one login. Okay, so that because I want to have a different login, I'm going to just go in and open another browser, and I'll show you how you're going to do it. If you want to have this chart, okay, Maybe we don't need to go through all this, but I'm just showing you. I mean, it's taking up time. But let's just go through this process anyway, so that you know how to set up these. These charts are in. They are coded in HTML5. Okay, so these are actually. That's why you can run this in the browser. Java charts you can no longer run in the browser because Chrome and all the browsers have stopped supporting Java. They don't support Java applets anymore, which is a shame because we had some really good charts on Java. Okay, so this we don't need. So I'm going to just go for trade.wander.com. If you go into trade.wander.com, it will give you it'll give you this kind of prompt. So you go for trade.wander. Let me put this into the into your this is actually 2410. So that's the first hyperlink. You also have, so this is a parallel way to get into the Oanda charts. One is you have the desktop icon, okay, so that's the desktop platform for Oanda. That's called the desktop platform. This is the web platform. Okay, how would you get into this kind of view on the web platform? You can also trade completely through the web platform if you're comfortable. But I personally find the desktop platform it's much easier to operate. So go into practice, put in your account name. So I'll put in mine, and I put in my, and sign in. Okay, so when you sign in, you'll get this kind of view, or whatever you left it at, as the last save layout. Now it is auto saving the last layouts. So all this stuff you get if you want to play around with all this, but right now we are focused on charts. So what you have to do is, by doing all this stuff, moving all this stuff here, just move out all this stuff. We don't need this race, just close it. By doing all this stuff, you can actually come to a state where, I'm not going to do this here, you come to this kind of thing, okay? You move out all the other windows, and then you can move out, I think this also can be moved out. You get a nice chart view. Now, you want a palette structure. Right now, you got only one chart, okay? So what do you do here? Look at this. Here it gives you multiple options. So we are going to choose, again, I'm going to show you those. Now I'm not going to show you 8 charts because then I have to go and create charts on all of them. Or link symbol to all charts. Link interval, let's do link symbol to all charts. And are you following what I'm doing? So I'm choosing this layout, which means now what it's going to do is, it will have everything is the same. I want to move this thing. This is a bit of a pain actually. I want to move this thing out. Yeah, and I can move this also up. Alright, okay, so what I've got now is, I've got sync. Now I'm going to move this also out. Alright, now what I've got is, it says link symbol to all charts. Now what I would do is, I'm not going to do it for all of them, but I'm just showing you. What is this? What is the time? Here we want something like a monthly, okay? This is the Dow Jones Industrials actually. And then if you zoom out like this with your cursor, okay, scroll down, then you'll zoom out, okay? So all these tricks you know. Let's make this again something that we want. Copper. Let's make this copper. I hope it loads quickly. Now, one of the problems on this platform is loading quickly. It loads a bit slowly. So now everything has become copper because I set link symbol to all the charts. Are you guys following what I'm doing?
Yes, sir.
Okay. So now copper, what I'm going to do is, obviously I want the time frame to be, I want the granularity to keep increasing as I go from left to right and top to bottom. Okay, so the symbol will remain the same. So I've got this as monthly. Then I'm going to make this, I'm going to click on this window, and then I'm going to make this time frame, I'm going to make it weekly. And then I'm going to zoom out like this. I'm not doing this for all these windows. So now you got the hang of it. You keep on increasing the granularity as you move to the right, and then go down here. From here you go to this window, okay? And then eventually you will come down to what you see in my display. You can set up your own display if you want. I mean, you don't have to have 5 minutes here. You can have 1 minute. Normally here I have 5 minutes, okay? So this is what will happen. Is this clear to everyone now? Okay, so this is how you set up the web charts through the web login on the same. So you can actually have the desktop login as well, and then this one also for chart. So this is a very good charting system. It's a little bit slow in terms of the way it loads, but it's a pretty good system. This is the way I think that charting should be done. When you're doing TA, you must look at as much data as you can get your hands on. Okay, otherwise you may get a very different kind of picture. So when you look at all this stuff, so this is copper. We'll go back to the analysis of oil. So first you have to set up all this stuff, and you've seen the other chart as well. You see the long-term picture, and you have to form a view. So you have to form a view. So today, Dharam, you're the gatekeeper. You have to keep track of how many people have gone out. Okay, so now you have to form a view. Now view, just don't get too confused, or don't get perplexed about by the enormity of the problem. Okay, view can only be either bullish or bearish. Okay, of course there's a third type of view that you can take, which becomes very relevant in option trading, which is that you take a view that the market will not move much at all. You say that the market is going to remain kind of very quiet, and it's not really going to move around, it's just going to float around here, and it's not going to move for many periods, or for a long period of time. That view is very useful in option trading, because in that kind of view, when you have that kind of view, you would just be selling options, okay, because you would pick up the time decay. That we'll discuss when we do the option trading project. But that's a third type of view. For the moment, we will not worry about that kind of view. We will just assume that there are only two types of views, either you're bullish or you're bearish. Is this clear? Okay, so it's pretty simple. You've already simplified your life. Now all you have to do is just think about surfing waves. Okay, and this is what it is actually. It's just waves. So you have to develop your own skill for. You may actually, so don't underestimate yourself. You may actually find that you have a skill for this kind of pattern recognition. You don't know what your skills are unless you actually put yourself to the test. Okay, so you just look at these patterns, observe these patterns, and eventually you'll develop a feel for the patterns. So you can take a view, and it's very simple, either you're bullish or bearish. So you have to take a call. Sometimes you may not have a clear view, that's also okay. Okay, that is quite different from saying that the market will remain in a range for a long time. That's a different view. The other kind of view, it's not really a view, is that I have no view because I'm not getting clarity. So that's also okay, in which case you don't do anything. Okay, so you take a view here, and so when you look at this price action, you take a view. Either there are only two things that can happen. Okay, and let's try and now concretize the view, which is already now quite simple. Either it's bullish or it's bearish. Now let's make it more concrete so we can be very, very specific. Okay, in our assumptions, there are only two types of assumptions you can make. Either you make the assumption, you see this low over here. Can you see that? Which we pointed out. Maybe I can just start this practice thing also, so that those charts are easier to manipulate. Okay, but you can see this point that I'm referring to here. Can you see that? This point, the highest low so far on this display. On this display, the highest low so far from which a new high was made. Okay, so if this low breaks, then this uptrend that you're looking at, this entire uptrend, because if you remember here, all the way from here, this 2016 January low, okay, all the way from here, the sequence of higher lows and higher highs has never been broken. Is this clear to everyone? Can you see that? It has not been broken. Okay, if you look at a certain degree of movement, it has not been broken because this one held, this pattern has held, and now you look at the daily, this is the daily chart, you see all this while it has not been broken. So if this one breaks, if this point here, whatever that is, looks like 64.5 or something like that. Let me just log in here as well. So you can make your life very simple if you proceed, and you'll see that you're not making a huge number of assumptions, and these are actually very, very close to reality. Okay, it is always true, this statement that we are making, that an uptrend consists of higher highs and lows, and a downtrend consists of lower highs and lows. Okay, this is not even at the level of a particular model or anything like that. When you talk about models, you become very specific. Those statements can be wrong. This business that when the pattern of higher highs and lows is broken, then the uptrend is over. Okay, this statement is like a universal truth. Okay, so you're on very solid ground. Okay, you're not making very aggressive assumptions. Okay, all right. So here, if we see, now we go here. Let's use this chart. Okay, so the point I was referring to is this one, which is around 64.15. Is this clear? Actually, here, this point. And if you see, you can read the low over here. If you position the cursor, the low is what? 6458. So 6460, let's say 6460. Okay. I don't know why it was so 6460 is the low. Okay, right. So there are only two now. You can simplify your assumptions. You can make only two assumptions at the high level. You can make two assumptions. Either you say that on this move down that is happening, okay, on this move down, the 6460 is going to break before we make a new high. So the high over here so far has been 77.06, okay, 77.06. So to simplify your view taking, okay, and this will make you very disciplined also in your view taking. To simplify it, you have to just basically take a call that between these two important points that we see, the highest high so far, 77.10, and the highest low from which the new high was made, which is whatever the 64.60, let's say, or 64.58. Between these two, which is going to crack first? Is this making sense to you?
Yes, sir.
You have to basically take a call, which means your bullish and bearish view, it really comes down to taking a call on which is going to break first. If you say, let's take it one by one. If you say that 64.58 is going to break first, as compared to 77.10, okay, or 70, whatever this high is, 77.06, okay, as compared to 77.06, 64.658 is going to break first. Okay, that is price will break below that first. Then your view is what? Bullish or bearish? Bearish, okay? So that means essentially you're saying that this long uptrend that we saw, okay, you can see this long uptrend on this is actually a multi-year low on the oil price charts. Okay, this low of February 2016. This entire rally from here will be at least neutralized, okay, if this breaks. And so that could be one of your views. And on this big picture level, there is only one other view possible. That is to say that the other side, you take the bullish view and say that no, 64.58 will not break. And in fact, 77.06 will break first. Okay, so that becomes a bullish view.
Yes.
That means you are projecting the continuation of this uptrend.
Yes.
Okay, so do you agree that now we have simplified matters a lot?
Yes. Yes.
Okay, and not only have we made matters very much simpler, we have also become quite precise.
Yes.
Okay, now you see that you have framed your assumptions in such a way that the moment your assumption breaks down, the market is going to give you that information straight away. Okay, you don't have to wait like a macroeconomic model or a NPV model or somewhere where you're using assumptions. There are different layers of assumptions, and it's very difficult to figure out when your assumptions have actually gone wrong. Here it's much simpler. The moment your assumption breaks down, immediately you get to know from the market price action. Are you following this? Okay, this is very important especially because you are operating in a zone where you're not doing, this is not physics or engineering. You're operating in a zone like economics and finance where the level of uncertainty is extremely high. So the error rate in forecasting is going to be very high. So therefore, there is tremendous advantage in getting early warnings that your assumptions have broken down, so that you can quickly get down to the risk management part, right? Yeah, I've repeated this part, but it's very important. Yeah.
Along with this, we can also have the news prompt open. Like,
yeah, are they giving you news? Because I thought that they're actually...
No, like we can open it on Google separately.
Yeah, you can open a separate Google News, and that's the correct way to do it. Okay, if you're trading oil, you should have a separate news feed set up for crude oil. Okay.
In TWS we had.
Yeah, TWS you had the news, so you can see. You remember you can make use of your TWS.
It's working fine.
Sorry.
It's working fine.
TWS working fine. It's not giving you delayed data or anything.
No, it's fine.
It's absolutely fine.
It left it fine.
Okay, but then I think since we have already started this project on this, let's do it here, because I think again what will happen is if we operate on futures contracts, then I'll again have to teach you the theory of futures contracts, and that I'm not sure that I can teach it to you in fast enough to help you complete. So let's do this project on this. It's not going to make a big difference.
So what we are doing here at prices.
So it doesn't matter, because your skill set is not going to, the training that you're getting by playing around with these spot prices is not, can be transferred to futures trading as well. Okay, because the patterns are very similar. In fact, when you analyze futures prices, by and large you have to work for long-term data, you have to work with the spot prices. Okay, only towards the end do you gravitate to the latest, the active contract. So don't worry about that, because that will only come, only thing that you're missing is the specific knowledge of futures contracts and the technical aspects of trading futures. Okay, all those aspects that we will cover separately. So this skill that you're developing, okay, here if you're developing a skill of navigating the oil price movements. Okay, this is whatever skill you develop here is completely transferable to trading futures in oil. Okay, so don't worry about that part. So we'll do it here because the charts are also quite good here, and you have already seen how to enter the data. I think right now it's too late to migrate again to TWS. Okay, so we'll do this project on this thing. So are you clear so far about this?
Yes,
That you have now broken it down, whittled it down to a fairly simple set of assumptions. Okay, so now this is your call, what you want to do. Okay, you do your own analysis of the pattern and you figure out for yourself, do you want to make a bullish bet or do you want to make a bearish bet based on the patterns that you see? And here nobody is stopping you. We can follow the news on the oil price also, and if you want to bring in some element of fundamental analysis into the picture, into your analysis, into your overall view formation, you can do that. Okay, you can read all the news, you can watch Bloomberg TV, what is happening with the Iran sanctions. Now there's some further tensions because the Saudis may also react. You know, there's this problem with the murder of that journalist who got killed. Now they're threatening, the US is threatening some sanctions. They may come up with some sanctions. The Saudis may react by cutting some output. So that is also bullish for the oil price in theory. Okay, so all these factors you should keep on absorbing the news, and you can bring it onto also, you can incorporate all this into your view formation as well. Is this clear so far? Is everyone following? So now let's say that what you have decided to do is you have taken the bullish view. You have taken the view that this 64.58 is not going to break. Okay, now in this case you bring the underlying position knowledge to the picture. Okay, so your underlying position is long and your view on the market is bullish, so therefore your action is to what? Hold on, not to do anything, right? So in this case, because your underlying position is long and your market view is bullish, okay, therefore your action will be not to do anything. Okay, so therefore obviously that's, as I said, you will not do anything. You are expecting, that's the situation we were discussing yesterday. Okay, so your basic plan is not to do anything, and therefore you expect that 77.06 will break and the market will go even higher, maybe $80, $85, etc. And then you'll be able to hedge your production at a much higher price. Okay, right. So so while I remember, I'll just try to. There's an interesting. Have you guys heard of Ryanair? Nobody's heard of Ryanair. Ryanair is an Irish airline. It's a very dominant airline. It's a very well-run airline. It's a very profitable airline also. It's one of the dominant airlines in Europe. It's actually a regional carrier, kind of like Air Asia kind of thing. So Ryanair, actually the reason I discussed Ryanair is because they are, they hedge a lot, okay? So a little bit of the discussion on, I think I put it here. Yeah, so I'll just put this into your, there's an interview with the CEO of Ryanair, so it is not connected to this discussion, so let me put it in yesterday. So there's a discussion with, you can just watch this interview on YouTube, there's a view. So he's talking about his hedging also. Now these guys have seemed to have hedged at around $58 or $60 or something. So and he's talking about other airlines which are not hedged. So this airline hedging discussion which we had, you can add some more flesh to those ideas by listening to this discussion, okay? So so these guys are quite active in hedging their jet fuel risk. So okay, before I close this, in the meantime, I'll just show you. There's a new class which Lalita will tell you about. So this is your class today. Sorry, I'm jumping around. I just want to close this. This is class today. Then we have one on 29th, last period. Then 31st, first period. And then this is the one that has been added for the one that was missed. So 5th of November, okay, last period. I tried to mess up your Choti Diwali also, but Lalita said no, do it on 5th. Okay, is this clear? What? No. No, then you attend. See, 1 minute. Now you're all 1 minute. You're all adults now. Don't behave like crybabies. Okay, if you wanted to have time off, many of your seniors have done this. They're very smart. Yeah, they're very smart. They maintain a high run rate all the way to the end, and then they take the last 4 classes off. Nothing wrong with that. Okay, although we don't want to encourage that, but I'm saying that if you do that, at least you're smart. okay, at least you're not stupid, you're smart. You maintained a high run rate and took the last 4 classes off, that's okay. So then you don't be a crybaby. If you wanted to do all this, you should have planned it ahead of time. Yeah? Is this clear?
We don't have the classes.
Somebody is already outside. You can use a lasso, just block them and draw. Yeah. 1 minute. What is the problem? What? So if you have a question, so then you can just tell me, which let Lalita send me a mail. I've already done it for a lot of people, Sandhya, Pallavi. So then you let Lalita send me a mail. Satyam also has been corrected. Many people have been, that's been adjusted for many people. Just sit, Giri, just wait. Follow the discipline. Okay, so this is your, so this mail may not come from Lalita for a long time, so I'm just informing you, okay? So you have a class here. Alright guys, now let's get back to work. I needed to close that spreadsheet. Okay, what are we saying? Let's say that if you formed a bullish view and you know that follow the logic, okay? This is the logic that you need to learn. You can transplant this logic to all other situations, all other markets and all other positions. So you're in this market, your underlying position is long. After your view formation, the view you come out with is bullish. So therefore the action is not to do anything, okay? So that's your basic plan, not to do anything, and you have a plan that you expect prices to rise eventually above 77.06, maybe 80.85, etc., and then you'll hedge at a higher level. Okay, that's when I segued into the Ryanair discussion. Yeah, 1 sec. So remember also what we discussed yesterday about the contingency plan. You know what a contingency plan is? That's a backup plan. In case your basic plan does not work, what's your plan, backup plan? This is very important, especially from a risk management. When we are talking about risk management, like I said, your basic plan essentially is your forecast. Okay, it's based on your forecast. Your forecast is bullish, and that's why your basic plan is not to do anything, not to hedge. Okay, so your contingency plan is for the scenario when your forecast goes wrong. Is this clear? Are you following the structure? So you have to have, because I said this level of uncertainty is very high, okay, so forecast accuracy is likely to be quite low. So you need to be prepared for that. So you need to have a basic plan, but you need to also have a contingency plan so that you're not caught off guard by the market. Okay, so the contingency plan in this case will be to leave what kind of order? Let's say you're hedging and unhedging 100% at a time. Then what will be the order you leave for your contingency plan in this situation? Is my question clear?
Yes.
No? So the basic plan here is underlying position is long, market view is bullish. So the basic plan is not to do anything, not to hedge, observe the market and hope to hedge at higher levels. Yeah, so the contingency plan will be, and here we are assuming 100% hedging, unhedging, just to make it simple. So there will be a stop sell order for 1 million barrels. Here you can only do, your underlying position is 1 million barrels. Here you can only do 1,000 barrels at a time on this platform. So you trade multiple times, okay? So there will be a stop sell, but conceptually there will be a stop sell for 100 or a sell stop order at for 100% of the position, okay, at just below this level of 64.58, I think is the level. Yeah, 64.58. Is this clear? Okay. You can look at the pipettes also, the third decimal, I can't even see it. I think it's 64.58.8. So you can actually go as, you can, there is another bid offer element in this, which I have to, I don't know if you want to spend some time doing that. Okay, let's look at that. I think it's an important thing to be aware of, okay. Now, this is something else that you have to learn about trading systems. This is part of the learning of about trading systems and the quirks of each trading system. Every trading, you worked on TWS. TWS is a very sophisticated piece of software, okay? So when you place stops, TWS gives you options. If you go into the settings, you'll see it gives you options. You know, remember when you say stop, okay, if you place the, if you place a stop loss level, okay, now obviously you have to choose a level that is just below that. So if it is 64.58.8, I'm going to say 64.58.7. Is it 8? Yeah, it is 8. 64.58 is the low. So my stop trigger conceptually is going to be 64.58.7. because 7, if the market trades at 7, that means that that 64.58.8 low has been broken. Okay, you can say, why are you being, I think sometimes the Pangshu used to say, no, let's use a 5% band, so let's allow 5% break. Okay, so I think all those refinements are not really materially useful. So just keep it simple. 64.58.7 means that's my stop trigger level. Now the question is, when you place this, this system does not give you too many options, but TWS gives you a lot of options. So when the market is watching for 64.58.7, it can watch for it in multiple ways. Okay, so the system will ask you, on a sophisticated system, you should be aware of this concept. On a sophisticated, say the sophisticated system, it will ask you, do you want this 64.58.7 to be monitored on a bid basis, or a offer basis, or a traded basis? You understand the difference? Remember, we looked at all the order books. You saw how all the stuff was moving around, bids and offers, and trades are also happening on the TWS. Also, you can see when trades are happening, it is highlighting the trade price. Okay, so there are 3 things to be aware of, especially when you are setting a stop level or any other order trigger level. Okay, now there's another additional refinement to be thought about, which is the system is going to ask you, do you want this to be watched on a bid level, or an offer level, or a traded level? Okay, so if you say bid level, okay, the moment the bid comes to 64, here you can see the bid offer prices. You can see the bid offers 65.1 and 68.1. Okay, this is a little bit wide because we are still in, I don't think London has opened yet, so that's why this is a little bit wide. Okay, this will have to wait till New York actually. Okay, but you can see 65.1, 68.1 is the bid offer. Okay, so if you have, so this is like a 3-cent bid offer, it's a bit wide, it should be a little narrower, because if you look at the TWS, you'll see that there is a 1-cent bid offer. It's very tight on the TWS, because that's a direct futures contract. This is a CFD which is based on the futures contract. Anyway, so 65.8, 65 and 68 is the bid offer. Okay, so if you place the order on a bid basis, the moment the bid goes to whatever that 58.7 level, okay, the moment the bid goes there, it will trigger the order. It will release a market sell order. Okay, but ideally when you are putting a sell stop order, you should not put the bid. Okay, the right way to put, because the bid cannot, if the, like, see right now you see the bid offer is quite wide, it's 3 cents. Okay, in liquid, and when New York comes in, I expect that the bid offer will become tighter. It will become maybe closer to 1.5. Okay, so so what will happen is, if the bid offer widens for some reason, okay, if the bid offer widens for some reason, then what will happen is automatically your order might get triggered. Are you following what I'm saying? Because you've told the system to watch the break of that level on a bid basis. That should never be done for a sell stop. Similarly, for a buy stop, you should never ask the system to watch on a offer basis, because the offer, the spread widens, the offer can easily go above the level, and the market will not actually trade there. Are you following? Spreads can sometimes, depending on what happens, suddenly if you get some news that US is imposing sanctions on Saudi Arabia, prices can become very volatile. Okay, the markets, all kinds of stuff happens in markets. Okay, so if you saw, like, there are historical events which you guys have not seen because you're not, maybe not even born. In 1990, there was a coup in Russia against Mikhail Gorbachev. There was an attempted coup. Suddenly the spreads on all the foreign exchange markets like dollar Swiss went to 10 big figures basically. Like what you see here on dollar Swiss now is 99.48, 99.49, right? So this became like 99 and 1.09. It became so wide because the market was in panic because there was a coup in Russia. So all these kinds of things can happen. So this is the point that you need to be aware of, that anything can happen in markets. Okay, there are no limits here. Anything can happen. So here, especially in OTC markets. So therefore, if you put a sell stop on a bid basis, that is not the right approach. Are you following this? Or is it going over your head? Tushar, I hope you haven't given up like yesterday. Okay. So logic, what I'm saying is, if you are putting a sell stop, right? You are looking for a break of this level. This level being, yeah, you want a price, you want to, not the one. Yeah, 64.58.8. You want to exit when the market breaks 64.58.8 and you have set 64.58.7 as your trigger price. Now the system can watch the trigger in 3 ways. It can watch as 64.58.7 bid, or offered or traded. There are three different things. Okay, so when you are putting a sell stop, never put it on a bid basis, because if the spread widens, the bid can easily go below the trigger level, and it will trigger your order. Okay, it's just door not fully closed. Mittal, just close this door fully. Just slam it shut. Okay, so never put the sell stop on a bid basis. Are you following? Okay, so you can only put it on a traded basis or on a offer basis. Okay, so the traded basis will get you into the market quick. Will trigger the order faster typically. Okay, when the market actually trades there, it will get you into the. It will release the sell order, market sell order. Or offer is even later. Offer is going to be even later. It's much more. I mean, that means you're giving it like kind of like what the Pangshu said. Give it a little bit more room to penetrate. Give it 5% penetration of the level. That is kind of like setting it on an offer, setting a sell stop on an offer basis. How is the system supposed to watch that trigger? On what basis? Offer, bid, or traded? Okay. So traded is the right way, according to me, is the right way to do it. And
that should be offer basis.
Offer basis, like if I say that 64.58.7, watch this level on an offer basis. So it will wait till the offer goes to 64.58.7, which means by that time the bid is much lower. The bid is much lower. The bid might be 64.55.7, and the offer will then come to 64.58.7. So by that time the bid is much lower. Okay, and the mid price, which is like the traded price, the proxy for the traded price, the market is already traded sufficiently below your trigger level. But because you have kept it on an offer basis, your order is just being triggered now. Because the offer takes time to come down, right? Are you following now? Okay. So this is the rule basically. You can listen to the video once again and understand it. That you have to be prepared for a more sophisticated system in real life, like a TWS, which will give you the option to specify how the stop trigger is to be watched, or how an MIT trigger is to be watched. Is it to be watched on a bid basis, or an offer basis, or a traded basis? Traded is the best way according to me, but certainly you should never put a sell stop trigger to be watched on a bid basis, and you should never put, okay, now let's do Namita and Lakshay. Write down Namita and Lakshay. We'll have that more penalties. Okay. Okay. All right, guys. You have to remain engaged. Okay. You can't just switch off like this. Okay. Because you have taken finance. I was just wondering why 58 people have taken finance. Because I don't think 58 people are that interested. It's a lot of hard work. You have to remain engaged. Okay. So the rule that I'm giving you, you can listen to this and understand the logic once again later on. But the rule that I'm giving you, on a sell stop order, you should never place it to be watched on a bid basis. Okay, and similarly on a buy stop order, you should never set it to be watched on an offer basis. Traded is the best. You can if you want, you can make the sell stop trigger. You can instruct the system to watch the sell stop trigger on a bid basis, or the buy stop trigger on a bid basis, and the sell stop trigger on a offer basis if you want.
This is all done to ensure the liquidity.
No, it is all done to, it's just giving the system more specific instructions. Mainly the idea is that you don't want to exit the system, you don't want to exit the position unless the market has actually broken that level. You see, the problem with a sell stop, if you place a sell stop to be watched on a bid basis, any kind of market panic when the price is near this price but it has not broken this level, if the market goes into some kind of panic based on some news, suddenly the bid offer will widen and the bid will fall below the price, but the market has not traded below the price. Okay, so that's why you should never put the sell stop on a bid basis and never put the buy stop on an offer basis. Okay? Unfortunately, on this system, okay, this is why there are many flaws with this in this Oanda system. This system watches stops on a sell stops on a bid basis and buy stops on an offer basis. Okay, this is one of the flaws I've written to them many times to change this, but they are not willing to change it. So this is a problem that you have to be aware of. So what you have to do, I want to discuss this, it's a finer point, but I think you have to be aware of all these aspects because it will teach you the different ways to look at a system and how to be aware of using a system. Okay, so what you have to do, so now you understand there is a problem in the system. Okay, so if I do, let's say if I do this, if I place my sell stop, the lowest price is 64.58.8. okay, that's the critical level, which if it breaks, it will break the uptrend. So I'm choosing the trigger as 64.58.7. okay, now if I enter 64, suppose I enter here. Now obviously the one problem you already know is that if I place, now if I want to set up, choose an entry sell, and I have to choose, let's say I choose 1,000 contracts, and what is the price we looked at? 58.7, no, 64.58.7. So, all right. Now, if I do this, what's going to happen is, the moment the bid goes to 64.58.7, okay, it's going to trigger my order. Okay, it is going to release a market sell order into the system. Okay, now the problem is, here's the problem. Okay, this is a little bit complex. Just pay attention and try to understand it. But it's important to be aware of all these complexities. If I can't place 64.58.7. Let's understand why. Okay, because the system is going to watch the orders on a bid basis. Sell stop will be watched on a bid basis, and buy stop will be watched on an offer basis. Okay, now what is the problem? Now these charts that we are looking at, this chart that I'm looking at, okay, which is showing me the lowest price here as 64.58.8. These are actually not based on low bid and high offer and all that. These are actually mid price charts. You understand what is mid price? Mid price is nothing but bid plus offer by 2. Bid plus offer divided by 2 is the mid price. Okay, so mid price in this kind of a system where you don't get to see the traded prices. On TWS you get to see the traded prices, what price is actually trading. On this system you don't get to see the traded prices, you get to see only bids and offers. So the mid price can be taken as a proxy for what is the traded price typically, okay, in this kind of a system. Okay, so even when you do derivatives pricing, normally what people do is they take a mid price, they derive a mid price, the theoretical price, and then they add a spread, and then they add a spread and they create the bid and offer. So first they derive the mid price. So the bid plus offer by 2 is the mid price. Okay, now these charts are actually mid price charts. Okay, so if you see, if you do a different chart, you do a min max chart, you can do a min max chart also, but I don't think it's required for this project, because I'm just highlighting this here. If you create a min max chart, this is a different type of chart. Okay, you see the problem here. When we were looking at the mid price charts, what was the low? 58.8. Okay, what is the low now? 56.8. So you see the difference? That means when the mid price low was shown to you as 64.58.8, the bid at that time was actually 64.56.8. Okay, so if you are placing a stop, so there's another way to place the stop is, and when you come down to the stop level, you've got actually the problem with this kind of chart is these are not nice to look at. I mean, at least I don't find them nice to look at. Nobody looks at these kind of charts in the real world. Okay, so but this, at least these guys give you the min max chart. So the best way I think to understand. So you understood this problem?
Yes, sir.
Because those bar charts we were looking at, they are actually mid price charts. So the high low on the bar chart will only be the mid price high low, which is bid plus offer by 2. But actually what you can see is when the mid price low was mid price chart was showing you a low of 58.8. The actual low bid at that time was 56.8. Okay, so 2 cents difference. So therefore, if you place the stop at 58.7, okay, if you place the stop at 58.7, the bid can just go to 58.6 or whatever. Even if the bid goes to 58.7, it will immediately trigger your sell order. Which means what will happen is that even though the market actually did not go to a new low, okay, because when your bid is at 58.7, the mid price is not 58.7. The mid price is higher.
Yes, sir.
Are you following? Most people have lost me. Is it too confusing?
Yes, sir.
Too confusing?
It's a bouncer.
It's a bouncer. One sec. Now try to pay attention. Have you understood this point? Mid price versus min. The min max is showing you the low bid and the high offer.
Yes, sir.
Okay, so what we are seeing is because of the fact that these bar charts which I was showing you earlier, if we look at the two charts separately, okay. Okay, here now we can do it weekly. Yeah, this chart, you see the same point, 13th August. 13th August, these charts, the bar charts are, normally I like to look at bar charts, that's what most people do. They look at candles or bars. Nobody looks at min-max charts when they're forming a view. Okay, so when forming a view, I use the bar charts, but these bar chart high lows are derived from the mid price high lows. Okay, so the mid price low was actually 64.58.8, 13th August. Okay, but 64.58.8. Can you read that?
Yes, sir.
Where is it? Here. 64.58.8 L. Okay, but the same thing on the same data point. When I look at the same point here, actually the bid low. This is the min-max chart is showing you low bid high offer. Low bid high offer. So here the low bid was 56.8. So that means the offer must have been 58.8. What is it? 56? No, it must have been 68. Because it is 58. No. So the offer must have been 68.608. What happened? Now Tushar is lost. Okay. So the point is that when you are placing stops, what you should do is you can use the bar chart for forming a general view, because this is quite messy. Or if you are comfortable with the min-max chart, you can just use that chart. But when you are placing the stops, look at the min-max chart and find out the true level. Because the system is going to watch stops on a bid basis and sell stops on a bid basis, buy stops on an offer basis. Lot easier, but that's okay, because in a way it's good, because you through this exercise you will be sensitized to this aspect of because tomorrow when you go to work in some other bank, you might trade with a different system altogether, a third system. So you should be alerted to these aspects of a system. So when you get a new system, you should be alert to all these aspects. You should check this. How does the system trigger orders? Is there a default? Like in Oanda, there's a default. It uses, for sell stops, it uses low bid. For buy stops, it will use high offer. Okay, there is no way for you to change it. On TWS, it gives you a way to customize it. So you need to be aware that different systems have different nuances. So you need to be alerted to this aspect of a trading system. So this is okay, I think. You need to learn about these things. Okay, everything will not be simple. Tomorrow you'll come up with a fourth system or a fifth system that you have to work in. It will have all kinds of quirks. At least you should know what to look out for in the system. Are you following what we are saying? Okay. So let's simplify it now and say that you form your view on bar charts if you want. But when you're setting your stops, you set them using the min-max chart. So now we see the low is 56.8. So now I'll set my stop at 56.7. Are you following now?
Yes, sir.
Okay, so now what I do is I change this to 56.7. Alright. Okay, and then I can just put the entry sell order. So again, also remember this. So now you can see this order is there. Okay. Okay. So this is one thing. So the long story. We had a long discussion on this. I'm going to go back to these charts. So we were discussing how you're going to go about running your running your hedge book. Okay. So you form this view. Now you have already come to the point of the contingency plan. So the contingency plan was to place a stop sell order or a sell stop order at, now we have placed it at that level. Okay. So now you're covered on both sides. You have your basic plan, you're observing the market and you're hoping that the market keeps on going up. Okay. And if it doesn't go your way, then at least you'll be hedged below 64.56, whatever. Okay. Is this clear now? Okay. So this has to be the approach. And then obviously you're going to use multiple time frames. Okay, if you think that the price is going to go up at some point, because right now the short-term price action in crude oil is quite bearish. If you look at the short-term price action, if you make it smaller, like if you look at 1 hour or something, it is quite bearish. Okay, So at the least what you can see is, so use the idea of multiple time frames. You've taken a big picture view by looking at the weekly charts, and you feel that that low on the weekly chart is going to hold, and we are going to make fresh new weekly highs, okay? Fresh highs on the weekly chart, okay? But then if that's going to happen at some point of time, this short-term price action has to become bullish. Do you follow that? Okay? This is why we are saying that the larger time frames will dominate the smaller time frames. Remember when we discussed cyclicality,
Yes,
we discussed that larger cycles have to dominate the smaller cycles.
Yes, sir.
It is kind of a tautological statement. In mathematics, you heard this expression, what is tautological? Tautological means it's obvious. There's no need to prove it. Okay? It is obvious. So obviously, if the larger cycle has to remain valid, then the smaller cycle has to obey the larger cycle and turn around, right? Because if you have this uptrend on the weekly charts, and this uptrend is not to be broken, this part which you are zooming into now, this part which you see here when you zoom into this chart, 1 hour chart, you can see this decline in greater detail, but somewhere it has to quickly turn around because it's almost close to hitting that low level, which you are saying is not going to break. So somewhere the short-term price action has to become bullish. So what you can do now is also, as you are watching, you have to watch for some signs of short-term bullishness, short-term bullish price action. The first warning will be if the price can rise above the 70-10. Because you can see here on the short-term charts, do you see a downtrend? On the 1 hour charts, you can see a downtrend. So here you have this one high, second high, third high. You can take this if you want. You can take this as a fourth high. Okay, I would just take this as a third high. Then this is the fourth high. Yeah, and then you have a low. You have a low, and another low. Okay. So at the least it must break over this 70, this high, so that it can destroy this, so it can neutralize this downtrend here on the hourly charts, right? Then it gives you hope that your basic view is correct. That maybe again it is starting the upward journey. Is this clear? Are you following?
yes, sir.
So this is basically what has to be done, okay? And another thing that you have to do is obviously you have to watch you have to manage your risk in the sense if you're hedging or unhedging, you need to obviously here you don't want to operate on a 100% basis. If you want, you can do it, but the way you can manage your risk is by splitting up your position. Maybe not doing 100% at one go, so that you have a little bit more flexibility. But here I don't want to put constraints on you. You can just do whatever your view suggests. Okay, that's one way to manage, because remember here you can also make losses. You can also make losses because you may decide not to hedge. Okay, because the underlying position P&L you can't do anything about, and that's the same for all the teams. It is only a hedge position P&L that will make the difference. So you could make money or you could also lose money. So another thing that you have to look out for, which we haven't had the time to have this discussion on this topic, is that when you're running an active hedging program or a dynamic hedging program, okay? So good point that Tanuj made yesterday, that I was mentioning active and passive, but in the notes I had written static and dynamic. So static is the same as passive, dynamic is the same as active, okay? So another decision problem, this is actually a decision problem, okay? We have not yet discussed that aspect, that when you're running a dynamic hedging program, another decision problem that you have to solve is how much money should be put on the table as risk capital, okay? Okay, if you're running, let's say, a jet fuel hedging program for Ryanair, and if you're running a dynamic hedging program, you have to also take a decision on how much money are we willing to lose. At what point do we say that, okay, enough is enough, no more dynamic hedging, let's just lock in all the exposures and hedge everything now and just sit on it. Are you following what I'm saying? Because in this program you can keep on making losses, okay? So that is another actual discussion that actually has to go into it's be incorporated into the case, which is that when you have a situation like this, how does a company decide if they are running a dynamic, how much risk capital should they put on the table for this dynamic hedging program? $5 million, $10 million, $100 million, whatever it is, okay? So how do you come out with that decision? Not so much the actual answer, but how do you arrive at that decision? So for your own sake, you have certain amount of capital given to you, okay? You need to come out with a number. I'll leave that to you for your project. You need to decide a number, okay? And make sure that you stay within that number. So if you say that we are not going to lose more than $5 million in this whole project, that should be our cap. Then when you trade initially, then you make sure that you don't trade in for the full position, or you don't let the losses multiply. Okay, you don't let the losses multiply. You have to watch your losses. If you have said that you're not going to lose more than $5 million for the whole duration of the project, okay, then on the first day itself, if you lose $4 million, then it's not working, right? Are you following what I'm saying? It's the same thing like if you go into a casino, let's say you can play, there are many skill-based games you can play in the casino like blackjack, poker. These are all skill-based games. These are not gambling games, okay? In India, we have this peculiar mindset, all kinds of card games are gambling and all casino games are gambling. That's not true. Poker is a highly skilled game. The guys who win poker championships, world champions, they have like $10 million, $15 million prize money, okay? And there's one guy who's been winning for the last 4 years. So poker is a game of skill. So is blackjack, okay? These are all skill games. So if you go, let's say if you're going to go into a casino with a plan that I'm going to play blackjack or whatever, right? So you go in with a stake. You go in with $10,000, let's say, okay? So there should be a plan. Now that $10,000 is your risk capital. Let's say you're going to play for 3 days, okay? Now if you go in with 10,000, you don't go and bet 10,000 on the first game itself. Are you following what I'm saying? You have to apportion your risk capital. If you're going to be playing for 3 days, maybe you do 4,000 on the first day, 4,000 second day, then 2,000 on the next day. You have this kind of split. So this is how you apportion your risk capital so that you don't lose all your money. Your betting capital should not be gone in one day. The same thing you have to apply, the same logic you have to apply to your project. If your project is running for 5 weeks, maybe you have a plan that in 1 week, over 5 weeks, we will not lose more than 5 million. So a simple way to manage that further down the, in terms of splitting it down is then you say, in any given week, we will not lose more than 1 million. So that if every week we lose money, we still don't lose more than 5 million. Okay. So this is a very, very important aspect of, managing any kind of risk book, active or passive. That you have to manage, you have to shepherd you have to be clear about your risk capital. Unfortunately, what happens in industry is many firms are, even publicly listed firms, are not systematic about this. They don't think about their risk capital before entering into such a venture. They don't think about the risk capital. They don't manage it systematically. But this is how it should be done. Before you go somewhere, you have to, before you go in for a venture, like even going into a casino to play blackjack for 3 days, that's actually a very calculated, risky venture. Okay? But there's nothing wrong with that if you can manage your risk. If you start losing $10,000, then Tanuj will say, let's borrow some money from Aryan, let's borrow some money from Jayant, and let's bet another 20,000, I'm not going to lose. So if you start doing that, then you're already headed for trouble. You have to be able to control your risk, okay? So you have a plan, you make a plan, you go in and then you execute the plan mechanically. You do not waver from the plan. If you waver from your risk management plan, you're dead. Okay, so you have to just develop this discipline. So you can apply this logic in your own in this project management as well. Okay. Sorry.
These examples are good.
These are good. Okay, very good. Okay. All right. Okay. So are you guys now a little bit clear about what has to be done?
Yes.
Okay. So let's spend a little bit more on fun. So technical, I think we have covered most of the aspects.
Yes.
Okay, so you take the view, and then the last part of the discussion that we had on risk management and on and deciding what your risk capital is, that I'll leave it to you. Okay, and then apportioning your risk capital between the periods. So get all this systematic thinking into your head. That okay, you have 5 weeks. Say $5 million, 1 million each week. You don't have to be so conservative. You can maybe put 2 million in the first week. Then if you lose that 2 million, then you can cut it down in the next week. There are many ways to do it. You can play around on your. But the idea is that there must be some shepherding of risk capital. Okay, it must be. You should not just die straight away. You should die from 1,000 cuts. Are you following what I'm saying? That is, you should not just go and blow up everything on the first day. You should just bleed to death slowly. Your risk capital slowly you lose every week you lose 1 million. Okay, every week you lose 1 million. You should not lose 5 million in the first week. Okay, is this clear? So don't get demotivated by my analogy. Okay. Okay, guys. Now let's get to FA. So TA, I think we have covered. Let's give you some ideas for FA.
So for the TA part is this
See, so we have shown you how to take a view. Okay, now this business of how to take a view, that you have to refine on your own. And as I said, it's just like surfing. Don't be worried about that fact that you don't know anything about oil prices or anything. This is a perfectly legitimate approach. There are many people making lots of money who are trading from a purely technical basis. They might as well not know what this price is, whether it's crude oil, where it is made, how it is, how people drill for oil. They don't know anything about any of these things. But you can make money just by trading from as if you're surfing. So this is perfectly fine. Most important thing is risk management. That is the most important thing in this business. Okay. All right. Okay. We have still got. We have to cover. There's a lot of time. People are already getting restless. Don't get restless. 1 minute. Let me just. I'm just going to close this so that we have a little more memory. How to close a trade in Wanda?
Sir, by putting a limit by our stop.
Sorry, what's your question again?
How to close the trade in Wanda?
How to close the trade?
Yes, sir.
Okay, let's say, do I have any? Okay, let's do a trade. 1 minute. 1 minute, guys. Lot of activity going on, lots of murmuring, and please pay attention. He's asking a question: how to close a trade in Wanda. Let me first, for that I need to first buy something. Okay, let me just. I'm just going to buy it. Okay, so order executed. Okay. Okay, so now I've already gone long. You can see this. Okay, so now I have a position. You can either go to trades, okay, or you can go to positions. Now suppose I have. Suppose I buy crude oils, 5 more times. Okay, so I will have 5 trades, but I'll have only 1 position. It will aggregate all the amounts and it will show me the full amount. If I buy 100 units 5 times, when I go to positions, it will show me only 500 units, 1 row. But when I go to trades, it will show me 5 trades of 100. Okay, so depending on whether you want to, if you want to close the whole position, then you just go here and click on this and.
So it is a market. Sir, we are closing at the market.
Yeah.
So we want to close at some limit.
Then you place a limit sell order.
So how we have to modify?
1 minute. Okay. Then in that case, okay, let's do it. I understand your question now. You go to this order. You modify. You put in a take profit. Now first you have to click on modify. So you highlight that order. Okay. You go there. You highlight this trade. Okay. First it will give you the close option. Then you modify it. Then you place a take profit. You can place a stop loss also.
So what is trailing?
Trailing stop is essentially the idea behind it. I'll just give you the idea of the trailing stop. The trailing stop is this. The trailing stop idea is that suppose I had bought oil at. Now suppose I had bought oil at let's say this point, okay, and then it went up, okay, and then it made this high, came back. Say I had bought it over here, okay. And so I'm watching it goes here, then it, so initially when I bought it here, my stop was over here, okay. When I bought it here, my stop was over here, let's say. Now it goes up, makes this pattern, then goes and makes another high, okay. So when it makes another high like this, I can see what is going to happen now is that, see, I was obviously bullish that's why I bought it, okay. So now it's made a fairly important low here and then made a fresh high. So I can already see one low, second low, first high, second high, okay. So the basic trend structure has developed, an uptrend has developed. Now what needs to happen to neutralize this uptrend? It needs to break below this clear, this level where I put the thing. So then what I'm going to do now is when I had gone long here, my stop was over here because my view is bullish. So what is the logic that will make me exit my position? The neutralization of the uptrend. Okay, in broad terms, the logic that will drive me to exit my position is the neutralization of the uptrend. So the point at which the uptrend will be neutralized has now changed. When I first started, I assumed that this was the uptrend. So this is where from the uptrend began. Okay, so that's why the stop was here. So now that point has changed. So now that point is here. So what I will do now, I will modify my stop loss. Okay, from here, I'll click on that trade. I'll do modify and then I'll change the stop loss to this level. This is called a trailing stop. It is trailing because it is always less favorable than the current market. Okay, even if you looked at a short position, the same logic will apply. It would be a trailing stop. It would be less favorable than the current market, and it is trailing because it is trailing the market. So in the sense that suppose Gaba is walking ahead and somebody is trailing him, so that As he walks 10 paces, the other guy also walks 10 paces. So it is actually kind of following the market in that sense, right? Is this clear?
So that means that it is like the proxy of 7.2 to 7.2. The same thing.
That is the point. That is the point. So it's a way. 1 minute. 1 minute. It's a way of. This is a good point. That if you remember, I had not discussed. 1 sec, guys. We still have some time. Let me cover this important point. Okay. Okay. There's too much talking going on here, guys. Be careful. 1 sec. There's an important point that he has reminded me of. Remember in your notes, I think I put this point that you can. There is no need to actively solve 7.2.
Yes.
That is a legitimate approach. I've already told you this. Okay. So this is that's okay. So that's good. So I'm just refreshing that idea. So what I just showed Sahil just now is that I bought this here, okay, and that time the stop was over here. Now as the market makes a new high, okay, after making another low here, and then I can actually raise my stop loss from here to here. Okay, this is a trailing stop. This is called a trailing stop because it is kind of following the market and trailing the market. And this is the way that you actually use 7.1. Remember what 7.1 is? Exit on loss. Okay, exit on loss actually means exit at a price less favorable than the current market. That's what it actually means. Okay, so this will happen now. What will happen at this point? Now that the market has gone all the way up to here, where do you think my stop is now? Is it still here? No, it has actually gone up all the way here. Okay, so what has happened with this oil that I bought at this level at 34.95, let's say. Now, initially my stop was here at 25. Now this stop has gone all the way up to 64. Okay, so then in this way, I have never kept any take profit order. Right? You follow that? I never kept any take profit order. I just kept on trailing my stop. This is called trailing my stop. I just kept on raising the stop as the market kept on making new highs, okay, from new higher lows. I kept on moving my stop. So this is how, this is again a very legitimate approach, okay, that it simplifies your system further. One decision you don't have to take. That 7.2 decision you would never have to take at all. Okay, you are just trailing your stop and using 7.1 to proxy 7.2. Is this clear to everybody now? You follow what was meant? If you remember the Donchian trading system, remember the Donchian system? Can you see that this is what that is also doing?
Yes. 4 week high.
So Donchian makes buys on 4 week highs and sells on 4 week lows. Okay, so once you buy on the Donchian, you never really actively take profit. You are only using a trailing stop. So the Donchian also has this feature that it does not actively solve the take profit problem. Is this clear?
Yes, sir.
Okay. Ishan is keeping time again, waiting for the end. It is over?
Yes,
Oh, 2 minutes are left.
No, it is getting over like.
Huh?
You was 20 minutes, right?
No, there are 2 minutes left, guys. 1 sec. Let me just quickly, 1 sec. No, we have some serious business. Okay, 1 sec. We have some serious business. I still have to show you FA. Okay, so let's finish that business. Okay. 1 minute. 1 minute. Don't behave like kids. 1 sec. Don't behave like kids. Okay, just let's get this job done so that the next class we can move on to more theoretical. It's very slow. No, there are 2 minutes left.
Now it's 1 minute.
I don't know why it's not loading. Okay, so what you can do is, I'll just give you a clue. 1 sec. For your fundamental, you may be a little bit starved of FA information on crude oil, copper, etc. Okay, so what you can do is you can go to the CME group website and look for the futures pages for those, look for the futures contracts for those commodities. Those 3 commodities and even the currency futures you can get, okay. So go there on the CME web pages for those contracts. You will see lots of information, lots of videos. CME makes a lot of videos. And I'll try to send you some links later on FA information. But on the CME contract pages, you will find video links. People are giving market commentary. Okay, so you can look at that and get fundamental information and set up a news feed also. All right, okay, guys, you're done.
Thank you, sir.
You can take your cable, data cable.
Fundamental analysis is
Yeah, 1 minute. Do you have anybody on the technical question? Then I will make sure the video keeps running. Yours is technical? Yours is technical? Yeah, what is it?
in this fundamental analysis. We use all the news in the fundamental analysis, all the contextual and theoretical.
Yeah, all the news. I don't know why this thing is. My system is also. Yeah, what are you saying? In FA, yeah, FA is all the news. News is all part of FA. Plus all your economic data.
And view is formed according to that market view.
So you see right now the fundamental analysis of oil seems to be, well, it's balanced on both sides. There's a lot of expectation of
The US
supply.
sanction coming in, it is expected to be bullish or bearish.
The sanctions by itself obviously are bullish because there's oil,
Yes.
the Iranian oil will be taken off the market, so supply will reduce. But there are also other aspects there's supply. But generally seems to be, the drift of the fundamental analysis seems to be for stronger oil.
We are dealing in spots in Oenda.
Yeah.
So that's why we are looking for this futures in this.
This is just to give you information. Don't worry about the instrument.
Like if we were working on TWS, then we should work.
So it comes back to what Tushar was also saying. Don't worry about the instrument. Your market outlook is unlikely to change from instrument to instrument. Because those are just instruments.
Suppose I have taken a low position on particular asset. Okay. So earlier it was the price was rising. Now, but suppose I have purchased it over 1,000.
Okay.
Now price has gone to 900.
Okay.
Okay, so if I'm running a hedge book or I'm hedging low, so if it is more than 1,000, price is more than 1,000, so I will not take any action because it is already in my favor. But when it goes to 900,
So you're saying your underlying position is long at 1,000.
but if the price was rising, so I will not take any action. But when the price starts falling, earlier I had not taken any action, so now I will go long on it. But that is what I am saying.
Your underlying position is short or long?
Underlying position is long.
No, then if it is falling, then you go short, not long in your hedge book.
Okay, I will go
If you
short.
go long, you're going to be increasing your underlying position.
Okay,
Your total position.
if I
Your
go
net
if I
position.
go short, then later on when I cover up that position, when I close that position, it cannot go. The position cannot be more than the underlying position. No?
Initial underlying.
Initial analysis cannot go beyond the initial underlying position. That is what I mean.
So if you start with 1,000, and your initial underlying position is 1,000 units, you're saying 1,000 units, or is it
2,000
more?
price or 1,000?
At price of 1,000, the price of 1,000. So let's say it is 100 units. Then when the price, if you think prices will keep on rising from 1,000,
Yes, yes.
then you don't take any action. If you feel prices are falling now, okay, they start to fall below 1,000, then you have to start looking to hedge. And how much you hedge is between 0 to 100% of your hedge position, of your underlying position.